We'll do one question, one follow-up, and if we can get through one round, we'll hopefully do a second, and we'll see how much time we have after that. So please make sure your phones, by the way, are on silent or vibrate, because you don't want that funny telephone ring going off in the middle of the press conference. With that, Governor, the floor is yours.
Thank you very much. Good morning, everybody. Bonjour tout le monde. Senior Deputy Governor Wilkins and I are pleased to be here to answer your questions about today's interest rate announcement and the monetary policy report. Before taking your questions, let me offer a short summary of Governing Council's deliberations. It is important that we keep recent developments in context. The Canadian economy was operating close to its potential for most of 2017 and 2018, and inflation is at target as a result. Governing Council is, of course, preoccupied with the recent slowdown in the economy. If it were to persist, then we would foresee inflation trending below target in the future. Nous croyons que le ralentissement de la croissance.
Our belief is that the slowdown of growth to a below potential pace will prove to be temporary. It is important to understand that many disturbances affect the level of economic activity. And as they work their way through the economy, the growth rate declines. However, once adjustment to the disturbances is complete, growth resumes. Let me apply this idea to the current global situation.
Forecasters were expecting the global economy to slow during the latter part of 2018 and into 2019. This is because the U.S. economy had accelerated following fiscal actions, the effects of which would fade during 2019. However, the world economy slowed more than expected late last year, and this is persisting into early this year. Although one can point to a variety of contributing factors, one common factor is trade conflict. This is delaying business investment decisions in many economies and slowing trade further. Once the economy has adjusted, this heightened level of uncertainty will no longer weigh on growth. An escalation of trade conflicts would, of course, pose a downside risk to the world, but progress in resolving these conflicts would represent an upside risk. Here in Canada, we are not immune to these global developments, but we also have some issues of our own to deal with. Governing Council focused on four. First, as discussed in some detail in our NPR in January, Canada's oil sector remains under considerable stress. Since January, oil prices have firmed, including those received by our Western producers. But limited access to markets remains a significant source of drag and uncertainty. This has led to another downward revision in investment intentions in the sector. Some of this downgrade is likely more structural in nature, as it represents the continued adjustment of the sector to global oil prices of $50 to $60 per barrel, rather than the much higher prices of 5 years ago. This adjustment process is also being reflected in wages and other costs, and in housing market developments in Alberta. Importantly, as investments in the oil patch are pared back, Canada's growth slows. But when those investment levels stop falling, Canada's growth will pick up, even if oil sector investment does not, because other areas of growth will come to dominate the data. Second, uncertainty about future trade policies has risen again here in Canada. We have seen subdued business investment in most sectors for the past 2 years. But we were hopeful that the combination of the signing of CUSMA and the government's accelerated investment incentive would lead to a pickup in investment. On ne sait pas encore quel va être l'effet global. Mais les doutes quant à la ratification de cet accord restent un risque à la baisse pour nos perspectives d'investissement. Par ailleurs, les exportations ont été très faibles au début de 2019. Les données sont un peu déroutantes, peut-être en raison des mauvaises conditions météo. Cependant, nous les avons prises telles quelles quand nous avons mis à jour nos prévisions, en laissant une porte ouverte à une croissance additionnelle dans les mois à venir. Ainsi, tant pour les investissements que pour les exportations, nous avons des raisons de croire que la croissance sera plus forte dans la deuxième moitié de 2019. Third, we've been monitoring developments in the housing market very closely in order to understand how the effects of local tax changes, changes in mortgage guidelines, and past rises in interest rates would play out. In part, the analysis is complicated by the adjustment of previously frothy markets, the Greater Toronto and Vancouver areas, to a significant revision in price expectations. Many other markets across the country, such as Halifax, Montreal, Ottawa, Winnipeg, are seeing solid activity. This is what would be expected in an economy that is growing, with rising population and a strong labor market. Par conséquent, à mesure que la situation va se stabiliser à Toronto et à Vancouver, le secteur canadien du logement devrait globalement croître de nouveau plus tard cette année. De plus, les taux hypothécaires ont diminué à la suite de la baisse des rendements obligataires mondiaux. En même temps, les accessoires de maison, les rénovations ont fait bonne figure au début de l'année, contrairement au reste des ventes au détail. Il faut noter que les mauvaises conditions météo ont peut-être également une influence sur les ventes au détail. Fourth, there have been several fiscal announcements since our last report. Initiatives taken at the federal level and in Quebec and BC will add to Canada's GDP growth. However, the lowering of projected government spending in Ontario is sufficient to more than offset all of those. So fiscal policy now represents a net downward revision to our growth outlook for 2020 of about 0.2 percentage points. The Governing Council is of the view that monetary policy needs to maintain a degree of accommodation sufficient to offset these various headwinds until the economic outlook improves. The economy has slowed and some excess capacity has reemerged, although this excess capacity is not generalized across the entire economy. Indeed, the service sector remains very strong and is creating many new jobs, and there continue to be a lot of job vacancies. Furthermore, global and Canadian financial conditions have eased a good deal since our January MPR. For example, 5-year fixed mortgage rates have declined by more than 60 basis points. All of this suggests that there is good reason to believe that the economy will pick up in the second half of the year. Governing Council, therefore, believes that this positive outlook is consistent with the current interest rate setting. In our rate decision, we chose to remove the reference to the need for interest rates to return into a neutral range, which we revised to 2.25 to 3.25%. We had originally added this reference to neutral to remind people what policy normalization could look like. In the current situation, we feel it's important to emphasize that we will continue to evaluate the appropriate degree of monetary policy accommodation as new data arrive. In particular, we are monitoring developments in household spending, oil markets, and global trade policy to gauge the extent to which the factors weighing on growth and on the inflation outlook are dissipating. And with that, Senior Deputy Governor Wilkins and I will be happy to take your questions.
All right, so as said, let's try one question, one follow-up, and we'll see if how many we can get through in the time we have. First off, Kevin Carmichael, Financial Post.
Governor, I know forecasting is extremely difficult, so this isn't a criticism, but I do wonder if you have any particular concern over how badly the bank did miss the drop-off in growth that seemed to have started at in the second half of last year, and whether you've learned anything that might strengthen your forecast going forward.
Well, if we look at it just as a bunch of numbers, then yes, I mean, it's of course no one likes to make forecast errors of any size, but we know it's part of the business. But I think in this case, the main thing that we were trying to do is to capture something which is quite ephemeral, which is business sentiment and how it translates into investment decisions. This is not measurable. We do surveys, and surveys give us a sense of how people are feeling, but they don't translate into decimal points in your forecast in any regular way. So and furthermore, the shock that we're dealing with, the one that is actually a forecast error, is a global one. And so it's sentiment shared by companies globally, certainly in countries that are trade dependent, which is why you see so much attention, for example, to Germany, and it was one of the first countries to show the sentiment indicators rolling over. Just something like 80% of the revenues for the DAX, companies listed on the DAX, come from abroad. So very trade dependent. So in that setting, that it's a question of, for the forecaster, well, okay, I can tell people are uncertain, and I can see in the surveys that uncertainty is translating into hesitation to invest, scaled back investment plans. But there's no way to put a number really into that except to put placeholders in your forecast. And I think that's what we did for the NAFTA uncertainty. And we had to, throughout that period, continue to update that as the data arrived. And I think the same thing is true at the global level. So, maybe that sounds to you like an excuse, but I think it's the reality that you're really trying to forecast. It's inherently not really forecastable. What we take some heart from is that if the situation were to persist as it is today, that at a certain point companies say, I've decided not to do this investment, and so that's a peel back from something I was going to do, and now I go on with life as it is. And so the essence of that is that to an economist, then that affects the level of investment and therefore the level of GDP. While it's happening, it pulls down the growth rate of GDP. But once you get there, the growth rate of GDP resumes as it was before because the drivers are still there. Drivers being population growth and actual consumption and job growth. So that's I think the main reason why we consider it to be temporary, even at the global level. It's that sense that the levels are being adjusted. And of course, if we get a degree of resolution of those tensions and less uncertainty, then of course it would turn into a positive dynamic. Of course, if the opposite happens, then we'd have more negative shocks to deal with.
Follow up to that, you mentioned the hiring numbers. They seem to have decoupled from basically every other significant data source out there. Could you discuss why that seems to be the case? And just in addition to that, I've often heard hiring described as a lagging indicator. So there's reason to. So I guess the question ultimately is, what is the hiring numbers or the jobs data telling us about the economy going forward?
So I'll just say that this if you like, disparity between labor market indicators and GDP indicators is not unique to Canada. There's a lot of countries reporting on that when we meet in Basel and in Washington just a week ago. So there could be something fairly profound underway that is doing that. But anyway, I think I won't speculate on that. I'll just say it's something we need to understand. But why don't you take over on the employment side?
So having been in the forecasting business for a while, we of course used to think that employment in hours were sort of a lagging indicator. In fact, when you check the data, they seem to be quite coincidence, which means there's a little bit less labor hoarding going on than it used to be. And you can imagine that companies, when they've got less sales or less activity going on in their restaurant or whatever, they tend to adjust downwards, hours or people, and the opposite is true. Now, that being said, you do look at the data, and you see that over the last year, on average, it's been pretty strong. 28,000 per month on average is quite a hefty number. It's above trend. We had two pretty good months at the beginning of the year, and then March it fell off a bit. And so obviously we're going to be looking at that on the employment side. But when you look at other sources of data, so the vacancy rates, which are still above 500,000, and you look under the hood of other kinds of indicators, you see that it's a pretty healthy market. And we asked businesses, and you saw that from our Business Outlook survey, that they do see a few, less pressure in terms of having trouble finding people. In part, that's because they've either hired the people they need, or they've invested in capital, or it's because they're hiring different people. They've kind of given up on hiring the perfect person, and they're hiring people, young people out of school, and they're training them. So of course, it's not one single labor market in Canada. It's running a little healthier in Ontario and Quebec and other provinces where growth are stronger, less healthy in Alberta and other, energy-intensive provinces. One of the litmus tests of the health of the labor market is just to look at wages, and you'll see in our report that overall wage growth is still modest. It's about a little over 2%. But if you take out the energy-intensive provinces, it's running about 2.6, which is a little bit less of a puzzle than we would have thought. And the governor quite rightly said, well, this is a global phenomena. Clearly, we've talked about this before, that it's in part probably due to the digitalization of the economy. You've got some gig employees, you've got a global labor market now in some industries, as well as less unionization, which gives less opportunity and less maybe desire on the part of workers to kind of risk their jobs, which they're glad to have, to ask for higher wages. So putting it together, I think labor income growth in our forecast is expected to be healthy, like we've seen in the past, and that's important for our outlook because it supports consumption.
Kim McCrail, Wall Street Journal.
Can you characterize a little further the tone of the policy discussions you had leading up to this rate decision, and discuss whether or not those discussions included the possibility of a rate cut?
Well, I think the tone, I would summarize the tone as a little bit skeptical of some of the most negative data that we'd received. I mentioned, that we had I don't know where you spend most of your time, but it seemed like where I was one of the worst winters I can remember. I can remember lots of them. And if you saw, CP's results yesterday, they talk about, shorter trains and, slower speeds. And so, if your exports can't quite get to port in time, then they don't get exported yet. So things kind of slow down because of weather. So all to say that, there are questions around that. We tested in many different ways, how strongly we felt about the temporary nature of the slowdown. As we said in January, we saw this as a sort of detour that, we were already, as good as close as at home as it could be. The economy still had its pockets of issues that we're still adjusting, but most of 2018 we felt like we were really close to where the economy would end up. So a bit of a detour, and perhaps a duration of around 2 quarters. So that that's Q4 and Q1, so that in theory we're into the positive frame already, but it'll be a while before we have the numbers to firm that up. And so that's the other thing. The skepticism goes both ways. Well, we'd say it's by all bits of analysis, it's a temporary thing, but we need the proof. We need the data to support it. And we're seeing little snippets globally, and so we're not discouraged. We're hopeful that those data points are lining up and along the story, and we're actually confident the more time that goes, and we see no new shocks, that's exactly what will happen. So as for this business of what about the future of rates? We removed the reference to neutral. As I said, we put it there when we felt we were firmly into the normalization phase of policy. The economy had reached very close to home, and it was time for us to be quite purposeful of getting to neutral wherever that was. And we didn't want markets to think that was like hopping on an escalator, just going up and up and up. We wanted them to understand that we believe there was a natural limit to how far rates would go. in this process of normalization. So it was to characterize what normalization could look like. And so something in that 2.5% to 3.5% range, which, you know, as we do at this time of year, we've dusted that off and we conclude it's maybe a quarter point lower than we thought before. It's not a really big change, but it's a difference. And so that since we are obviously in this stage shifted to a ground where we're watching the data to make sure that the forecast is being validated and so on, that yeah, if there was a new negative disturbance, that would be something we'd have to consider as fodder for whether interest rates needed to be revised down. So yes, data dependent means that. The data from here will tell us what to do. But if our forecast is right, then, which I firmly believe it is, what that means is that, you know, interest rates are more likely to go up than down, and that, you know, over time. But it's a question. The data dependency goes into how the pace could develop. And so, you know, I think of us as not just walking away from that notion of neutral, rather it's a key concept for how we grind out in our models and how we figure out where the economy is going. So it's always going to be in our conversations. And so, but for now, it's set aside until such time as the economy dictates that it's relevant to the conversation.
Some economists seeing the NPR this morning have characterized the forecast over the coming year as fairly conservative compared with consensus estimates. Do you see it as conservative? Is the bank trying to give itself a little bit of room?
I don't think nothing purposeful about that. I mean, I think the data in the last couple of weeks, you know, kind of tied a bow on you know how the first quarter in particular is likely to look, and even there we've got conflicts in the data. So if you put a higher weight, let's say, on the GDP at factor, I keep saying factor cost, yeah, GDP at basic prices data point for January, you'd be encouraged by that, and you look, and if you put most of your weight on the labor market, you'd be encouraged by that, and then you get the expenditure indicators, and they're not in line with those things. And so the way the forecast gets reconciled is by you know, inventories rising, you know, contributing quite a lot to GDP, estimated GDP growth in the first quarter. And then in the second quarter, we get a recovery, but it's a modest one because inventories are in principle running down. So it could be as simple as, you know, for example, you know, based on what you've read, that there's a pile of canola seeds somewhere. You know, that is just one example. We know oil inventories in Alberta are quite high. They're working to run those down. So the inventories appear to be across the economy. Some of it may be structural, right? Like we call it the Amazon effect, because you stockpile these warehouses. So so that, you know, I don't think it's as I said, not purposefully conservative. Would you agree? It's just the idea that we've taken the data as they are, and we haven't said, oh, that you know, the export data looked quite suspicious because every single category went down. Like you rarely would see that. And so you might say, well, let's just put 50% weight on that. But no, we treated it as real. If it gets revised up, then that'll be good news for the monitoring. Do you want to add anything, Carolyn?
Well, just the extent we focus a lot on Canada, but a major input to the outlook for Canada is the global economy. That's always true, but it's even more true now given this common factor that the governor was talking about that's kind of weighing on growth right now. And if you look at our outlook for the global economy, it's actually quite in line with other forecasters. It's slowing to something that's close to potential, but the dynamic is having you know, growth firm in key places like China, for example, I think that our outlook there is pretty balanced. We saw some more slowing than we thought we would get. The Chinese authority have responded with more monetary stimulus, fiscal stimulus, and it appears to be already working through. So I would say that the forecast is balanced, and that's a prudent thing to do when you've got the job of trying to not get the growth forecast right, but to get the inflation outcome right.
Julie Gordon, Reuters.
Can we just talk about how sort of a new negative shock could be fodder for a rate cut? Does that mean that at this point, just for clarity, you're not seeing anything right now that would lead you to a rate cut, that the next move would still be a hike? And then if we were to cut, would we eventually see that return to hikes relatively quickly, considering the more positive outlook in 2020-21?
You know, it's a little less mechanical than you make it sound. So let me just start there. Well, I think what we're trying to convey is that right now we believe that this setting of interest rates will give us the outlook that we've got here, which is a positive outlook that growth picks up in the second quarter and picks up for real in the third quarter, so the second half of the year. And that means that the opening up of excess capacity is a pretty temporary phenomenon, and not that large. Okay, and furthermore, as I mentioned in the opening remarks, it's not uniform across sectors. It's in pockets. Unlike most actual slowdowns in the economy, which can be very general, they're everywhere, so you get the same pressures everywhere. So for all those reasons, we call it a detour, and that's to say, well, we need time for the data to prove that, and we need time for once the data begin proving that, to make sure that the excess capacity that we've already identified is indeed being absorbed. And so certainly there's no, if everything turns out perfectly, there's no rush to suddenly get back in the saddle. It's more a question of letting the data speak. And as you can see, not only are we data dependent, markets are highly data dependent. And so part of what has happened over the last 3 months is that there's been a significant easing of lending rates in the economy, both for households and for firms. There's been narrowing of credit spreads, so not just lower rates in the risk-free space, but also credit spreads are lower. So all that's to say that that easing of financial conditions is playing a role in the economy. That's the market being data dependent. So my sense of it is, as the data turn more positive, which is exactly what we would expect, you'd expect to see the market to react to that, and you'd see that first. You'd see those kind of confirming signals that everybody saw it. But given where we are today, we think that rates are appropriate for this outlook. And I'll repeat that if another negative came along, we'd have to think about that over again, which is standard procedure. We're data dependent in both directions. Right now, we need some positive data to actually confirm that this outlook is the appropriate one.
And you mentioned in your opening remarks sort of 4 areas of concern for the bank. Can you highlight one of those as sort of the most concerning for the Canadian economy and for your outlooks?
Well, I said that those were the issues that preoccupied governing council. I mean, the point is when we do this exercise, the reason why it's such a rigorous and finely tuned process is that we look at everything all at once. And it's not like we're making policy in our heads every day. We put everything down and do this in these 4 windows per year. And so we look at absolutely everything. But the things that attracted most of our discussion, of, well, how long would that last? Could it last longer, or or is it almost done? Those kinds of debates about duration of things focused on the 4 things that I mentioned. So I mean, housing is not surprising because we've been highly preoccupied with it for some time. And so that's I think, if anything, housing has the most question marks around it, the reason being that we have a variety of housing markets. Yeah. You know, if someone wants to ask a question about housing in particular, we'll answer that. But that I would say that was probably the thing we talked about the most. Wouldn't you agree? Yeah.
That and trade, the global trade conflict.
Yeah,
and,
so there you go.
Those
See,
two things.
This is what a debate looks like in governing council. I have my things.
You wanted me to say yes,
know,
didn't
there you
you?
go. Yeah, I sort of did, but that's okay.
Both of those things, though.
Well, you're right about that.
Heather Schofield, Toronto Star.
Hi. You mentioned in the NPR that you see the effect of the carbon pricing on inflation to be less than 0.1% annually. I'm wondering if you could talk a little bit about the growth assumptions behind that and the, well, and break it apart a little bit in terms of the composition of that growth effect.
Sure. Do you want to cover that?
So that, sure. This is the carbon pollution charge. What we did was is look at what that was going to do to the level of to CPI inflation, and we came up with 0.1 for 2019. That is halved in 2020, and beyond. It's a very simple calculation. We looked at the charge that was going to be put in place and the effect on the direct effect on components of the CPI, the gasoline, natural gas, and fuel. And ran that through. It gives us 0.1. Of course, you can imagine it's $20 this year and $10 for the next one, so that's why you get half the effect. What we haven't done is have any kind of indirect effects that might go through industry, but again, those are very probably slower moving and have offsets, and so difficult to anticipate. But again, we don't think those would be particularly big from an inflation targeter's point of view, and so we're content with sticking with the direct effects.
And just to follow up, I'm wondering, we've seen quite a serious politicization of the U.S. Federal Reserve, and I'm wondering how that changes your own contemplations of monetary policy and how you wrap it. I mean, how you wrap that political uncertainty into your modeling and into your thinking about where to take things.
Well, I mean, political uncertainty is affecting many of the things that enter our models. But the least of them is monetary policy. I mean, it's what is more I think significant is that's where the uncertainty comes from on the trade front. It's 47 countries have experienced a slowdown very similar to our own. That's not a coincidence. That's 47 countries that rely on international trade in order to do business, and they're unsure what things will look like. That's what I call political uncertainty. Yeah, so I mean, it's the manifestations of it that figure in. I mean, you can't. I don't know how you would incorporate political uncertainty except in where it shows up. And again, as I said at the beginning to Kevin's question, I mean, how do you quantify that? You really, you're sure there's a negative effect on sentiment and therefore on business investment decisions. But how big? You know, when people say, "Oh, I have to invest because I'm at capacity and I'm going to disappoint my customers if I don't," but I'm going to put it off because I'm not sure what this is going to look like. Or what, so how do you get that into your model? Well, you're kind of thinking, well, during NAFTA it was this big, so let's assume this, and then we monitor the situation closely and update it. So I don't have a really great answer for you. And political uncertainty is not just in Washington, of course. There's political uncertainty in other places, but you know, just when in the old days when I was actually a forecaster as opposed to the client, which is how I feel now. Although some days it feels like I'm still the forecaster. I used to say that it only takes a little bit of politics to mess up a great forecast. But that's the thing. It's just an unknown. So it's one of your array of shocks.
David Cochran, CBC.
Hi, Governor. I want to ask you about the fourth factor that you highlighted there, the fiscal announcements in particular in Ontario. You say that there is a net downward revision for the growth outlook of 0.2 percentage points. How big in total is the Ontario negative impact, and do you foresee any further changes with the shift in approach that we're going to see in Alberta?
Well, you can do the forecast part.
Sure. On the forecast, so it's important to be very clear about where this negative comes from. We always take what has been previously announced and put it in our forecast. And so in January, we had a spending line that was from the previous government. And so the fact that the Ontario budget has a very different spending line is where that change comes from. The shock to our forecast is worth 0.2. Of course, since in 2020, but since the federal, BC, and Quebec were a small positive, the Ontario change was worth a bit more than that. I don't want to give a precise number because the decimal points aren't important, but it's a little bit bigger than 0.2. With respect to the change in government, I'll let you answer that question, but the fact is we are not going to change our forecast until there's a new budget that's been announced. So.
Well, that's right. Our convention is we'll only react to actually announced policies, and so if the new Alberta government has a different fiscal policy, then that'll get incorporated when that occurs.
Okay. And just to pick up on Heather asking a question about carbon, you talked about the inflationary impact on that. Is there a GDP impact on that? Is there any dampening effect in growth that you see there?
No, not really. It's what the thing is. The way this works is supposed to work is like if you were just raising the price of gasoline and fuel oil and natural gas, then of course that would reduce spending power for other things. But as economists would call that the income effect of higher pricing. But the government is, giving the money back, so that income effect is not relevant to your analysis. So then the question is so what does the money get spent on? And the way such a pollution charge should work is that over time it causes people to buy less of the polluting things because they cost more, and then that value goes somewhere else. So it's a very deep kind of structural shift that is something we would just see evolve naturally over time and not try to forecast it. How many new green technologies may develop because you could buy something to attach to your house that somehow allowed you to use less natural gas. I don't know. I mean, they have these things like for smokestacks that capture the heat, and you don't do it. But then if you had to pay a higher tax, well, maybe you would, right? So those kinds of businesses can grow, and therefore you've got new sources of growth in the economy. So right now, I'm just saying, well, those are the kinds of possibilities, and it's a wide menu, so we don't try to capture that in our forecast.
We just have a little over 5 minutes left, so I'm hoping we can maybe just focus on one question and see if we can get through a couple more.
We'll try to answer faster, maybe, but
Yeli Inde, Market News.
You mentioned how important, even more so, the global economy is and more for your forecast. Does that mean that you are in a stage right now where you have a higher correlation with the Fed policy, for instance? How did the general shift in central banks influence your decision?
Well, that's an interesting question. Historically, Canada and the U.S. have been quite highly correlated, and monetary policies have been quite highly correlated. And then people take from that the wrong conclusion, which is that we follow the Fed, which is not true. Well, when don't we? It's when the economies are not correlated, and that would be the best example is when we have a terms of trade shock, such as when oil prices fell dramatically in 2014-15, and during 2015 we cut rates in a year that the Fed raised rates. So that's pretty uncorrelated, right? So that's because the economies are highly uncorrelated. We're still, as we said, still dealing with the legacy of that shock to some extent in Alberta. And we had some more sort of a doubling down of some of those effects. Another decline in intended investment in the oil sector is in train right now because of the events of the fourth quarter. So, the two economies aren't exactly in sync, but we all are experiencing a common shock. That's true. But that, and I think one thing I'll close on this, because I know you want me to be faster, is that that shock, as it stands, is one which, around trade, the main way we see it affecting people is by less investment, right? Because that's the uncertainty effect. And that, in time, if those conditions persist, or if there was an escalation of trade conflicts, those things result eventually in lower productive capacity. So in other words, some of the benefits of past liberalized trade begin to go away because you have less liberalized trade. And so, as economists would call that a supply shock, not a demand shock. So the economy is slow while that happens, but supply is going down at the same time as demand. Okay, so it is not a shock that central banks would necessarily see as a reason to ease into, because it wouldn't do much good. You wouldn't be, your inflation target actually probably wouldn't move much. The thing is that you actually have inflation rising because of tariffs, and possibly exchange rate realignments would cause for some countries, inflation movements, and so it's an ambiguous call about which way interest rates would go in the face of a true escalation of trade tensions.
Prabhu Vaidya, Banque Times.
Yes, just given the stock market's at record levels, but bond yields are lower than they were in January, just wanted to ask you, and you mentioned in the NPR about the inversions, yield curve inversions being maybe less useful for predicting recessions than in the past because of the buying in the long end. Is the bond market less useful in terms of giving information or predicting about the direction of the economy, or is the stock market becoming a better signal, or because of the long end buying?
Right. That's a complicated question, but I would say the bond market is still a very relevant place to watch how new data is processed and look at what has happened over the last 3 or 4 months. Now you say that much is intact, but the relevance of inversions of the yield curve, I think, are probably last, given that term premia have shrunk enough so that it's going to take very little by way of a shock to cause the yield curve to invert. It's more a question about how long did the yield curve invert, and did the yield curve invert because central banks were tightening, or did it invert just because bond markets saw some soft data and the long end did the inverting, if you like. So those are nuances around that, and I think you just have to be careful not to think of it as some sort of hard signal. Our basic story here is that the world economy and the Canadian economy are in a bit of a detour, that the slowdown is a temporary one. And I think stock markets and the credit spreads in the bond market are telling you that no one's looking for a really negative outlook for the world economy. The bond market is expressing a degree of skepticism about it. Let's see the data. Okay, so the bond market remains highly data dependent, and I think, as we see the tone of the data improve along our story here, I think the bond market is going to see some yields edging higher in response to that. That's exactly what data dependence looks like. So that's about what I get from it.
And unfortunately, on that note,
is there anybody left?
12.
Is there anybody that? I'm sorry.
If you want to stick around for a little bit?
I'm saying if somebody's on the list and they didn't get to ask it, it's because I gave an answer that was too long. I don't want to be blamed for that.
No problem then.
Okay.
All right. Lou Caldwell, Bloomberg.
Thank you very kindly, Governor. And I'd just like to ask a question essentially about the stance of policy and the neutral rate. Bank lowered its estimate by 1/4 percentage point. And right now we have household debt payments outstripping the growth in income by the most since the financial crisis. That's coincided with a sharp slowdown in Canadian consumption. In two parts, are you worried that that dynamic, debt growing faster than income, is something that poses a threat to financial stability? And secondly, what informs your confidence that rates and the current setting of policy is accommodative in light of all the factors you've talked about and the rate-sensitive sectors doing quite poorly?
Would you like to do that?
Sure. It's a great question. You can imagine we spent a lot of time thinking about that. The new range is based on a number of models. As you've seen, we've got a paper out, and I'm sure you've had a look at it. And so that kind of kicks the tires a little bit on what the range could be, even knowing that, of course, the neutral rates on, is not something that we can actually measure. But we do get a fairly firm range between 225 and 325. That being said, there's always a bit of uncertainty, and so you can expect that the interest rate increases that we did undertake, in conjunction with B20 and some local tax changes, would have had effects on interest-sensitive parts of the economy, like housing, for example, also consumption, and the parts of the consumption that tend to be more interest-sensitive. And we've seen that. Have we been surprised by how much? I mean, quarterly data are always going to surprise you one way or another. I think a really interesting analysis that we did, that we just published, is related to looking at the housing market. Because I think that's a place where you really want to untangle kind of the various policy measures that have been taken. And what we find there is that in the housing resale space, when things were going great in 2015 and 2016, particularly in the GTA and the GVA, which are kind of separate, there was a bit of froth. There was more activity in resales than you would have expected given fundamentals like employment and inward migration, affordability. And then subsequent to the policy measures that I just talked about, the opposite happened. And so what we're seeing now is in part related to the interest rate increases in B20. Of course, those are fundamentals. The housing market's going to react to that. But it's also related to kind of the undershooting that you would see as froth kind of works its way off. And you can see the froth working its way off by how price expectations, which looked like they were a bit extrapolative, have come down, particularly in the GVA and the GTA, and also the decline in investor sentiment. Whereas the other markets that didn't have that froth, that the governor mentioned actually in the opening statement, Ottawa, others across the country, look pretty much like what you would expect. Of course, Alberta is a little bit of a different story because of the effects of the adjustment to lower oil prices. So we're always going to be on the lookout for being surprised about how sensitive households are to interest rates. But we think that the bigger adjustments are related to the other policy measures and the froth coming off. In the consumption space, when consumers are indebted, eventually and highly indebted, and yes, it's a major vulnerability. It's the #1 financial vulnerability for the Canadian economy. We still believe that, even though it's stabilized. Well, at one point, households may start to say, I need to increase my savings. And in fact, we've built that into our outlook for consumption.
Andy Blatchford, CP.
The NPR mentioned immigration a couple of times, and I was wondering if you could unpack for us how the stronger immigration in recent years has affected the economy broadly, and also more in particular how it may have influenced the employment numbers, the healthy employment numbers we've seen.
Do you want to take it?
Oh, okay. Well, immigration is actually a pretty important part of this story. If you just start with the structural part, in 5 years without immigration, we won't have a growing labor input for potential output. So potential output growth would be a lot slower without that immigration. And so just the underlying momentum in the economy that's sustainable really is coming a lot from that source of population growth. And that shows itself up in a lot of places in the economy, like the housing market. And in a world where supply, in a sense, creates its own demand, so the fact we've got people that are buying things, that are using services, that are going to stores, that need houses, well, that creates a little bit of a boost to the economy. And so to that extent, you know, the immigration has to be contributing to demand in Canada. You know, are the employment numbers directly linked? Strangely, the employment numbers over the last year are some 350,000, and it kind of lines up with immigration. Is it a one-for-one relationship? Probably not, but certainly immigration is a big part of the story in terms of potential growth, which will feed itself into actual growth.
And it puts a floor under the housing market. So when we're analyzing, you know, when the housing market is adjusting to these shocks, our confidence that growth will resume comes from that, like that you are forming enough households that you've got to be continuing to construct. So that's why we refer to demographic demand for housing. And housing starts right now are running a little below what demographic demand would be. And so that fundamental positive force in the housing market remains. Regardless of those adjustments of froth that Carolyn was talking about a moment ago.
Unless Emily Bergeron? Emily, do you want a question? No? Okay.
Okay.
All right. Well, on that note, that's everybody in the room.
Excellent.
Governor, thank you very much for your time.
Yeah, thanks, everybody.